Hello, friends. Before you let a frightening headline make you worry about the money you work years to save, take a breath with me. Maybe you saw a post saying the IRS has quietly set a checking account limit, that your bank balance is suddenly too high, or that keeping more than a certain number of dollars in the bank could put you in trouble. For a retiree trying to pay for groceries, prescriptions, rent, a car repair, or simply protect money for the family, a message like that can feel personal. It can make you look at your checking account with fear instead of peace. But today, we are going to separate the rumor from the real rules, because the truth is calmer, more practical, and much more useful than the panic. And before we begin, please subscribe and turn on notifications. This channel is here to help you understand money, taxes, retirement, benefits, and the rules that can affect everyday Americans without the confusing language and without the scare tactics. Let us begin with the most important sentence in this entire video. As of July 2026, there is no published general IRS rule that says an American can only keep a certain dollar amount in a personal checking account. There is no magic balance where your checking account suddenly becomes illegal. There is no rule that says you must pull money out because you crossed $10,000, $20,000, $50,000, or any other number that somebody posted online. Your savings are not a crime. Your pension payment, Social Security payment, retirement withdrawal, home sale proceeds, inheritance, insurance check, or years of careful saving do not become suspicious simply because they are in your checking account. The IRS is concerned with whether income is properly reported and taxes are handled correctly. Banks have reporting duties for certain kinds of transactions, but those things are very different from a limit on the amount of money you are allowed to hold. So why are so many people hearing about a so-called checking account limit? Usually the confusion comes from several real rules being mixed together until they sound like one scary new law. One rule concerns cash deposits. Another concerns foreign bank accounts. Another concerns interest income. Another concerns direct deposit tax refunds. And another is not even an IRS rule at all, but a deposit insurance rule. When these are thrown into one social media post, it can sound as though the government is watching every dollar in your account and will punish you for saving too much. That is not a fair or accurate way to explain the rules. The best protection is not panic. It is knowing which rule applies to your exact situation, which rule does not, and what documents you should keep so that you can answer ordinary questions confidently. The number that causes the most confusion is $10,000. You may have heard somebody say, never deposit more than $10,000 or the IRS will come after you. That statement is misleading. The federal reporting rule people are usually talking about concerns currency transactions, meaning actual cash such as paper bills and coins. Financial institutions are generally required to file a currency transaction report when a cash transaction is more than $10,000, and they may have to combine multiple cash transactions that they know are connected and total more than $10,000 in a single business day. This is not a rule saying you cannot deposit that cash. It is not a tax bill. It is not proof that you did anything wrong. It is a report filed by the financial institution as part of federal anti-money laundering rules. Think about an honest situation. Perhaps you sold a used car, received money from an estate, had cash savings at home, or run a small business that takes legitimate cash payments. You may need to deposit a large amount of cash. The responsible thing is not to become frightened and scatter the money into smaller deposits just because you heard about the $10,000 number. The responsible thing is to make the deposit honestly, use the bank normally, and keep clear records showing where the money came from. A bill of sale, a closing statement, a receipt, an inheritance document, a payroll record, or business records can make a big difference if questions ever arise. A report about a cash transaction is just a report. It does not automatically mean the bank froze your account, that you owe tax, or that the IRS has accused you of wrongdoing. In fact, trying to break up cash deposits specifically to avoid the reporting rules can create a much bigger problem. This is called structuring. It means dividing transactions into smaller pieces for the purpose of avoiding a required report. For example, it would be a mistake to take $15,000 in legitimate cash and deliberately deposit $9,000 today and $6,000 tomorrow because you believe that will keep the transaction invisible. The law does not say that amounts below $10,000 are automatically private or free from review. What matters is the purpose and pattern. Do not let an internet rumor push you into behavior that looks worse than simply handling your money openly and honestly. When in doubt, keep your documents, speak truthfully to your financial institution, and get advice from a qualified tax professional before making decisions about a large or unusual cash transaction. Now, I want to make another distinction that may save you a lot of unnecessary worry. Cash is not the same thing as money sitting in your checking account. A bank transfer, direct deposit, wire transfer, electronic payment, pension deposit, Social Security payment, and regular personal check are not the same as walking into a bank with a stack of paper currency. Your bank can see activity in your account and may ask reasonable questions about unusual transactions under its own compliance responsibilities, but that does not turn your account balance into a forbidden number. The $10,000 cash reporting rule is about transactions and currency. It is not a general rule that says an electronic deposit of $12,000, a retirement withdrawal of $25,000, or a checking account balance of $80,000 is prohibited. There is also a rule called Form 8300, and people often misunderstand that one too. Form 8300 is generally associated with a trade or business that receives more than $10,000 in cash in one transaction or related transactions. For example, businesses such as car dealers, contractors, landlords operating as a business, jewelry sellers, and other businesses may have reporting obligations when they receive large cash payments. That is different from a regular person putting their own lawful money into a personal checking account. It is also different from an ordinary wire transfer. So when you hear someone say the IRS tracks all money above $10,000, slow down and ask, are they talking about cash? Are they talking about a business that received cash? Are they talking about a foreign account? Or are they simply repeating a headline without explaining the rule? Those details matter. The next source of confusion is taxes on interest. Your checking account balance itself is not income. The money you already earned, saved, inherited, or received from a lawful sale is not taxed again just because it remains in a bank account. But interest paid by your bank may be taxable income. If you receive enough reportable interest, you may receive Form 1099-INT, usually for at least $10 of certain interest payments. And even when a form is not issued, that does not automatically mean taxable interest can be ignored. This is why it is important to review your year-end bank statements and tax documents carefully. The issue is not that your account balance crossed a secret IRS ceiling. The issue is whether the income connected to your money, such as bank interest, was properly included on your tax return when required. Another real rule applies to certain foreign accounts, and it is important because the number is also $10,000. If you are a U.S. person with a financial interest in or authority over foreign bank and financial accounts, an FBAR filing requirement can apply when the combined value of those foreign accounts exceeds $10,000 at any time during the calendar year. Notice the word foreign. This is not a rule about your normal checking account at a bank in the United States. It is not a cap on domestic savings. It is a reporting requirement that can apply when foreign accounts cross a certain combined value. People with international ties, property abroad, overseas family arrangements, or accounts in another country should not guess about this rule. They should talk to a qualified professional early because international reporting can be more complicated than ordinary domestic banking. There is one legitimate IRS limit that may have helped create the rumor, but it is completely different from a checking account balance limit. The IRS limits the number of electronic federal tax refunds that can be deposited into one financial account or prepaid debit card to 3. That is a refund routing safeguard designed to help fight fraud and identity theft. It does not mean you can only keep 3 deposits in your checking account. It does not mean the account has a maximum balance. It does not mean your paycheck, retirement benefits, pension, or Social Security payment will stop. It applies to the way certain federal tax refunds are directed into one account. If someone tells you the IRS only allows 3 deposits, so you need to move your money, they are mixing up a refund rule with ordinary bank deposits. Some people also worry that a large balance automatically gives the IRS permission to take their money. That is not how an IRS levy works. A levy is connected to an unpaid federal tax debt and a collection process, not to an ordinary checking account balance being too high. In most cases, the IRS says it must first issue a final notice of intent to levy and give the taxpayer notice of the right to a hearing at least 30 days before the levy. If you receive a genuine IRS notice about an unpaid balance, do not ignore it and do not panic. Read it carefully, verify it through your IRS online account or an official phone number, and respond before the deadline. That is very different from a surprise rule that punishes people simply for saving money. And then there is the question that many people really mean when they ask about a checking account limit. Is all my money protected if the bank has a problem? That is not an IRS question. It is largely a deposit insurance question. At an FDIC insured bank, the standard insurance amount is generally up to $250,000 per depositor per insured bank for each ownership category. The exact coverage can depend on how accounts are titled, whether they are individual or joint accounts, and whether trusts or other ownership categories are involved. That insurance figure is not a limit on what you may keep in the bank. You may legally hold more than that, but money above your insured coverage can carry a different level of risk if the bank fails. This is why people with larger balances should learn how their accounts are insured instead of confusing bank safety planning with an IRS restriction. Let us make this practical. Suppose you have $100,000 in a checking account from years of saving, pension income, and a recent home repair reimbursement. There is no general IRS rule requiring you to take it out. Suppose you have $260,000 from selling a property. Again, that is not automatically a tax problem merely because it is in your checking account. But it may be wise to ask your bank about FDIC coverage, review whether the funds are titled correctly, consider whether you need cash immediately for bills, and decide whether a checking account is the best place for all of your financial goals. Those are personal financial planning questions, not reasons to panic over a supposed IRS balance cap. The right answer depends on your needs, your insurance coverage, your interest rate, your debt, your taxes, and your comfort level. The same is true when a large amount of money enters your account. A deposit is easier to explain when you can explain it clearly yourself. Keep your paperwork. If you sold a vehicle, save the title transfer and bill of sale. If you sold a home, keep the settlement statement. If the money came from an inheritance, retain documents from the estate or financial institution. If you took a retirement distribution, save the form 1099-R and the statement. If it came from insurance, keep the insurer's letter and payment record. If you are self-employed, keep invoices, receipts, bank records, and bookkeeping records. These documents are not something to fear. They are simply the paper trail that helps you prove what you already know, where your money came from, and why it is legitimate. Sometimes a bank employee may ask where funds came from or why you are making a large cash deposit. That can feel uncomfortable, especially when the money represents years of sacrifice. But a routine question is not an accusation. Financial institutions have legal obligations to monitor certain activity and may need information to understand a transaction. Answer honestly, provide reasonable documentation when appropriate, and do not let embarrassment make you defensive. At the same time, never give sensitive information to a stranger who calls, texts, or emails you claiming to be from your bank or the IRS. Use the phone number on the back of your bank card or visit the official website yourself. A legitimate concern should be handled through a trusted channel, not through a surprise message that demands action immediately. This is especially important because fear about new IRS bank limits is perfect material for scammers. A criminal may call and say your account has crossed the limit, your money will be frozen today, or you must move funds into another account immediately. Then may tell you to buy gift cards, send a wire, use a payment app, or share a code sent to your phone. Stop right there. The IRS says a letter or notice is generally the first way it contacts taxpayers, and the agency does not demand immediate payment by gift card, prepaid card, or wire transfer. Scammers create urgency because urgency keeps people from checking the facts. Give yourself permission to hang up. Talk to a trusted family member. Call your bank using a verified number. Visit irs.gov directly. No real government rule requires you to send your savings to a stranger to protect it. You may also be wondering whether the government can see every purchase you make. Banks maintain records and have reporting duties under federal law, but that does not mean every ordinary transaction triggers an IRS investigation. Buying groceries, paying rent, receiving your paycheck, transferring funds between your own accounts, using your debit card, or keeping money for emergencies are normal parts of life. The best approach is simple. Report your income honestly, file your tax return accurately, keep supporting records, and do not make banking decisions based on viral fear. If a transaction is unusual, large, connected to cash, tied to a business, or involves foreign accounts, pause and get qualified advice. But do not assume ordinary savings are illegal just because the amount looks large to someone else. For seniors, this message matters even more. Many older Americans keep more in checking than younger people because they are preparing for medical costs, home repairs, caregiving, property taxes, funeral expenses, or the uncertainty that comes with retirement. Some people receive a lump sum after selling a home or settling an estate. Others save carefully because they remember hard times. There is nothing shameful about wanting a cushion. The question is not whether you are allowed to save. The question is whether your money is safe, whether your paperwork is organized, whether your accounts are properly insured, and whether you understand any taxes or reporting rules connected to your particular situation. That is a much healthier question than, how much money am I allowed to have? Here is a calm way to handle this going forward. First, do not move money just because a frightening video told you there is a secret IRS limit. Verify claims through official sources, your bank or a qualified tax professional. Second, keep clear records for large deposits, sales, inheritances, insurance proceeds, and business income. Third, do not split cash deposits to avoid reporting. Fourth, review your bank interest documents at tax time. Fifth, if you have foreign accounts, business cash payments, or an unusual financial situation, get professional advice before the deadline, not after you receive a notice. And finally, review FDIC insurance separately from tax rules. Knowing the difference can protect both your money and your peace of mind. The bottom line is this: the IRS did not quietly impose a general checking account balance limit that tells ordinary Americans how much money they may keep in the bank. The real rules are more specific. Large cash transactions can be reported by financial institutions. Businesses receiving large cash payments can have Form 8300 duties. Foreign accounts can create FBAR reporting responsibilities. Bank interest can be taxable. Tax refunds have a separate direct deposit safeguard, and FDIC insurance has its own coverage limits. These are not the same thing. Do not let anyone bundle them together and sell you panic. You worked hard for your money. You deserve information that helps you make careful decisions, not headlines designed to make your heart race. Keep your records, use trusted sources, ask for professional help when your situation is complicated, and never let a surprise caller pressure you into moving your savings. If this explanation gave you peace of mind, please subscribe, share this video with someone who may be worried about their bank account, and leave a comment telling us what money question you want explained next. Stay informed, stay careful, and most of all, stay in control of your financial future.